I used to butcher my best setups. Sometimes I'd take profit too early, and other times I'd wait too long and give all my gains back. And here's the thing, it wasn't random trades, it was high quality setups, the ones that checked all the boxes and the ones that I'd wait hours to find. But when the time came to actually execute, I always got it wrong. I trimmed too early out of fear that the move would fail, only for it to do exactly what I thought and hit my original target. But when I decided to hold for the entire move and let it play out, it would fall short at some point before hitting the target and go straight to my stop. So I never knew what to do really. What should have been an easy green week full of well-executed setups turned into an absolute disaster. And not because the setups were wrong, but because my conviction was missing. I just kept reacting to price action over and over. So even though I was trading my system, I was still letting my emotions guide my decisions. And the problem was, I was treating every trade the same, whether it was a quality A+ setup that would run straight to target, or a C-level trade that I barely wanted to enter in the first place. Then it was very easy to confuse the two, and I'd wonder why I couldn't build consistency. And that's when it finally clicked. I didn't need more setups, I needed a way to separate the maybe trades from the must-execute trades. Because entering a trade and hoping it'll work is one thing, but it's not the same as knowing that it's worth the risk. So that's when I stopped asking, will this trade work? And instead I asked myself, are these conditions that demand a trade? That's the shift that changed everything, and finally got my weekly results looking like they should. So in this video, I'm going to show you exactly how to identify and trade A+ setups, how to ignore everything else, and exactly how to build that into a profitable system week after week. I always got the same advice, which was let your winners run, or cut your losers early, or just be disciplined. But none of that means anything. I wasn't struggling with discipline. I was struggling with not knowing what the hell I was supposed to do. Discipline only works when you have structure to apply it to. And that's what I was missing. So here's the thing. I had structure for my trades already, using the LCE model, which is my simple 3-step process for entering trades: level, confirmation, and execution. I'd wait for price to enter a supply and demand level, then look for confirmation that the price will move in my direction, and then execute that trade by entering and targeting the next level. It's a simple rinse and repeat process. I'll link some videos here explaining that whole process in detail so you can watch later. But the issue was that I didn't know whether my trade was high quality or not. Sometimes it moved in the opposite direction as soon as I entered and stopped me out. Sometimes it chopped for hours. Sometimes it went halfway to my target before reversing and stopping me out. In that case, trimming early would have worked well. And other times it would just run straight to target. Now, I used to accept this and simply thought that there was no way to know which one it would be. I'd just take all of them and treat them all the same. Well, no, I didn't treat them all the same, actually. I let price movement guide my emotions and exit trades at the worst spots. Sometimes I'd hold a B-tier setup like it was A+, hoping it would run, only to get stopped. Other times I'd trim an actual A+ setup way too early out of fear and leave half the move on the table. This made trading unnecessarily stressful and difficult. It shouldn't be this hard. So now, I don't trust my gut anymore. I trust the cloud. The 2050 EMA cloud tells you everything you could possibly need to know about whether a setup is worth taking or not. It tells you the trend direction, trend intensity, multi-time frame agreement, structural health, as well as entry and exit points. So before I take any trade, I ask one question. What level of conviction does this setup deserve? And that one filter determines everything. Whether I hold for full target, whether I trim early, or whether I even take the trade at all. And I break it down into 3 different levels of conviction, using the cloud. The first is high conviction trades. These are going to be your bread and butter, the A+ setups. Find these consistently, and you'll become a master over the market. These are the trades that build your career. It's where you go in with full conviction, hold to target, and don't touch a damn thing. This only happens when momentum aligns across all time frames. So for high conviction trades, this is exactly what I want to see. I want the higher time frame cloud trending strongly, up or down. This is usually going to be on the 1-hour time frame, but you can use the 30-minute and 15-minute as extra confluence. So this is what the 1 hour would typically look like for an A+ setup. In this case, the cloud is undeniably trending up. It's closely following the price and offering a thick blanket of support as the price keeps trending up and making higher highs. And on our execution time frame, which is the 5 minute, we want to see the exact same thing. We want the cloud to be trending in the same direction, which is trending up in this case. And this is what we see on the 5 minute. So we have both long-term momentum pointing bullish and short-term momentum pointing bullish. This puts everything in favor of the buyers and makes it much more likely to keep moving in that direction. This is the highest conviction we could have that a trade will keep moving in our direction. It's not a guarantee, of course, but it's when the odds are stacked most in your favor. The market has chosen a side. It's a bet I'd take every single time. For the trade itself, I keep it simple. I enter in the supply and demand level, place my stop under market structure, then target the next level, and then I simply let it play out and hold all the way to target. Since the odds are so lopsided, it's much less likely to reverse or stall and more likely to hit your target instead and even exceed it. And these trades are going to be the bulk of your monthly profits because they're so simple and effective. You can build a career just from these trades, but you need to be careful because there's another type of trade that might feel similar but isn't an A+ setup. These are what we'd consider B-level setups. And it's extremely important that you make a distinction between the two because treating these like an A+ setup or confusing the two will hurt your profitability. So that's the second tier of trades, which are medium conviction trades. This is where the setup is valid and the bias is still there. But momentum just isn't as clean. Either the higher time frame is trending, but the lower time frame is flat and indecisive, or the lower time frame is trending while the higher time frame is flat and indecisive. The thing is, it's not necessarily a bad trade because you still have probability pointing to one side, but it's not a great one either. Since the time frames aren't all aligned, it means that the conviction of the dominant side, whether that's buyers or sellers, isn't as strong. And that's an indication that price action won't be as clean. That means it'll be harder to read, more difficult to hold, and will work less often. It's just a more frustrating trade overall, compared to an A+ setup, because A+ setups are usually quick, clean, and easy to trade. But medium conviction trades are worse in every way. So when you pull up a chart and see a medium conviction trade, this is how you should trade it. You can either, number one, not trade it at all and wait for the next A+ setup, or number two, trim and manage it tight. In this example, the 1 hour is showing a strong bearish trend. This means long-term sellers are strong. But if we look at the 5-minute time frame, we see that the cloud is overall choppy and indecisive, and that's the difference. This would be much easier to read if we had a strong bearish cloud on the 5-minute as well, because it would stack probability heavily in one direction. But here, probability is slightly weaker. Our bias is still bearish here overall since the higher time frame cloud is trending down, but the lower time frame tells us that we have a chance to continue ranging, possibly get chopped out, and maybe even build enough structure here to reverse this and move higher. That's definitely not a trade we'd want to be stuck short in. It doesn't mean that's what's going to happen, but it has a higher chance of random and unpredictable movement when compared to a high conviction trade. So when it comes to trading this setup, remember to trade it, but don't marry it. Treat it like a regular trade with a stop above market structure and a target at the next demand level, but be more cautious. It might tease you a little bit. Try to preserve some profit and trim more often, because that'll probably lock in more profit overall than simply holding until your target gets hit. So that's the key distinction between high conviction trades and medium conviction trades. Now there's a third type of trade that might look similar to a medium conviction trade, but is definitely not a trade you should be taking. It will tank your profitability and make trading extremely difficult and unpleasant. It's a trade you should never take, and I'll explain why. These are called no conviction trades. No conviction trades are when the market is simply a mess. This happens in two scenarios. Number one is when the higher time frame and lower time frame clouds are flat or indecisive. And number two is when the higher and lower time frame clouds are trending in opposite directions. These are the type of trades I used to force just to stay active. But they backfired on me horrendously. The issue here compared to high and medium conviction trades is that you can't tell who's in control, so you have no way of getting an edge out of it consistently. The price can move in either direction with equal probability since there's no dominant force. And if you try trading this, it's impossible to read. You'll be extremely frustrated and exhausted by the end of it, with a very high chance of making zero profit at best and tilting at worst. Essentially, everything that's bad about trading and that ruins most traders. So we want to do our best to completely avoid these setups, Just because the price is at a level, it doesn't mean you should take a trade. You should only take a trade that you can get an edge out of over time. The high conviction trades fit that definition well, and medium conviction trades can sometimes. So now let's piece it all together to build a profitable trading strategy that works week after week. Depending on market conditions, an A-plus setup should present itself for at least 5 to 10 days out of the month. A very bad or slow month might have 5, an average month might have 10, and a great month can have 15 or more. Now keep in mind that this is a cycle. You will have slow months, but they won't last forever. And you will have great months, but they won't last forever. It's just a part of the cycle that every single business and industry goes through. Even trillion-dollar companies have slow periods and better periods. So what you don't want to do is be waiting for a high conviction setup, be annoyed when one doesn't show up for 2 days, then get impatient, force a trade and burn your account for nothing. All you want to be doing is looking for those 5 to 10 trades a month and executing them well when they appear. That should be your only concern while trying your best to ignore everything else. These trades will be your core. Now, once you've mastered nailing A-plus setups, you can just keep nailing A-plus setups and scale them up. Then you can build a successful trading career pretty quickly, while also avoiding the torment of trying to trade every move in the market and trying to analyze everything like most traders do. This is the fast lane. You can also choose to add some medium conviction trades if you feel strongly about them to increase your overall profitability. This is optional though, and it should only be done once you're pretty advanced, because every trade and every level to level in the market is on a spectrum. The worst trades, which are D-level trades, are the 50-50 trades. These are the worst trades because it's impossible to get an edge out of them mathematically. Not to mention you'll probably go insane trying to figure them out. And as you move up the ladder, you get all the way up to A-plus trades, which have the highest probability of working you can possibly get. So you want all of your trades to be A-plus setups, or as close as possible, and do everything in your power to avoid climbing down the ladder. This is the true game changer. If you try to take every trade you see, chances are you'll get bad results. And this is because you've unknowingly been mixing high conviction and low conviction trades together. But once you acknowledge the difference between the two and only start taking high conviction trades, you'll eliminate all the losses that came from chop, confusion, and bad trades. Your psychology will improve dramatically because you're not constantly fighting in the mud for nothing. And these can make your P&L skyrocket virtually overnight. So look, if you're still struggling with exits, it's not a discipline problem, it's a structure problem. And the solution is simple. Only trade what deserves to be traded. Stick to what's easy and avoid what's hard. Just trade A-plus setups. By the way, this is exactly what I teach traders inside my mentorship, to help them trade LCE correctly, get funded, and get paid. If you're interested, click the link below. And if this video helped, leave a like and hit subscribe. I'll see you in the next one.